Contessa, yeah, rising bond yields challenging stocks and also challenging the Fed, despite the best efforts of Fed Chair Jay Powell the past 2 days to calm markets down. Bond traders I spoke with offering this list of factors pressuring bond yields. You have massive fiscal stimulus potentially on the way, massive monetary stimulus in place, a strong growth rebound. Rick Reader just talking about that. Our CNBC Rapid Update looking for 6.5% growth this year. Inflation fears, including the Fed, aiming for inflation above 2%. That tells some bond traders that the Fed doesn't have its back anymore. And all that could lead to eventual tapering on rate hikes, which Powell tried to talk against yesterday. Now, Powell appeared to succeed over the 2 days of testimony in keeping a lid on yields, but each time he stopped talking, yields moved higher. The 10-year peaking Wednesday 143, dropping during his testimony, and this afternoon around 1.5, I guess 1499, close enough. It's the highest level in a year. The Fed so far has seen higher yields as a sign of the improving economic outlook, so it's not been worried about it. With rates still low, it doesn't see them crimping growth. But as the quick rise in bond yield shows over the past several days, the Fed doesn't have complete control of this market. When bonds want to run, they're going to run, no matter what the Fed chairman says, Contessa.
Yeah, you're starting to see a lot of, the financial voices of authority that we listen to talking about the fact that there's been easy money for a long time, that maybe it's time to rein it in. What are their options? We just heard Jay Powell say, no, we still need to act, that the economy still needs some support. I mean, what level are we looking at that might prompt the Fed to act?
Well, I think there's a couple things to think about here, Contessa. First, I think that in the market, we tend to look more at GDP. The Fed is looking very closely at the shortfall in jobs, which are 10 million. That number's been bounced around a lot. And an unemployment rate it sees closer to 10%. That's the focus of the Fed. And so until that happens, I don't see anything close to a reversal of policy. I think that's one. Two is that it's going to be more concerned not with inflation, but with higher bond yields potentially crimping growth. And I think at some point, and I don't know where that point is, and it's a big debate in the market, maybe it's a 2% 10-year, maybe it's 2.5%, the Fed could come in and put some pressure through buying on the long end of the curve.
So it isn't I don't forget what it was you and I who were talking yesterday about the idea that what the Fed really can directly control in terms of interest rates are very short end rates. But that's not to say that they don't have influence or the ability to control rates at the longer end through buying, right?
That's a really good point, Tyler. And it's a relatively new development in the years that you and I have been covering the Fed. Might I say decades we've been covering the Fed. It used to only control short-term rates. Now the Fed, using quantitative easing or asset purchases, if you will, can come in and buy on the long end and actually sell on the short end. And it could essentially flatten the curve or drive down long-run bond yields. It considered that earlier this year, kind of backed away from it. I'm not hearing talk about it at this point, Tyler. It's well to remember, the way to figure out the way the Fed thinks about yields is real yields, which is the yield minus inflation. So right now, that real yield is negative. When you get to 2%, well, then you got a zero real yield, which is still, by the way, very accommodative, but something above that might prompt the Fed to act.
All right, Steve, thank you very much.
Shepard Smith here. Thanks for watching CNBC on YouTube.